Welcome to another episode of the Real Estate Market Minute. My mission is to help you better understand the latest trends in the U.S. real estate market and share with you my analysis and industry expertise. I want to help you gain an advantage and feel confident whenever you're buying and selling real estate. I'm your host, Mark Salib. I'm a passionate real estate professional, advisor, and investor, and I love what I do. Follow and DM me on Instagram at The Salib Group. Send me an email, mark@thesalibgroup.com. And as always, thank you for tuning in to today's show. Remember back when it felt like investors were buying up everything? Cash offers were everywhere. There were house flippers everywhere. And there were hedge funds everywhere too. Well, now, according to a new report from Redfin, investor home purchases just fell to their lowest level since 2020. So what's changed? And more importantly, what type of properties and markets does this impact the most? All right, on May 28th, I came across a post on X from Redfin. It said U.S. investor home purchases fell 6% year over year in the first quarter to their lowest level since 2020, when the start of the pandemic grounded home buying to a halt. Prior to 2020, the last time investors bought so few homes was in 2016. The quote goes on to say, higher mortgage rates, slowing price growth, and rising construction costs are giving both investors and individual home buyers pause. Flippers and investors are scaling back and being much more strategic when they do buy homes. All right, now that second part there of the quote, this came from Tamara Maddox-Cabich. He's a Redfin Premier agent in Denver, Colorado. So why is Redfin saying this? Well, let's talk about mortgage rates and how they've changed the math completely for investors. And this is probably the biggest reason of all. You know, when rates were at 3%, when you can get a 30-year fixed, or, you know, a lot of loans were at that 2.5%, 3.5% range, investors, well, I mean, they could cash flow a lot easier, right? Monthly payments were dramatically lower. Cap rates were much, much better. Plus, you had explosive appreciation. So you had cheap money, and that encouraged investors to take risks. But here we are sitting at 6.5%, ranging close to almost 7% for mortgage rates, and it makes financing costs much, much higher. And so it compresses their potential cash flow in these deals. Not to mention holding costs are higher, so investors just have to be a lot more selective. During the pandemic boom, just about anything they bought worked. Today, and many of them say this, the deal has to really make sense. All right, appreciation as well has slowed a lot. You know, you bought stuff back then, you bought anything back then, right? And it was just wait about 6 to 12 months and property values jumped significantly in just a short amount of time. So that gave a lot of confidence for investors to invest. Now, of course, these days appreciation is much, much slower. You know, some markets are even proving to be flat or down. Condo markets in some of the Sunbelt areas in the South, right? They're correcting, in fact. So investors can't rely on that automatic equity growth anymore, and that changes their behavior. What else? Construction, renovation costs are higher than they've ever been. And if you're an investor that's a flipper, a home flipper, or one of these BRRR investors, value-add investors, you got to now look at labor costs being higher. You got to talk about insurance costs are higher, right? Costs for materials are higher. Not to mention your carrying costs while you're renovating are higher, right? Energy bills even, property taxes, insurance, all of those are carrying costs that are now higher for you. So there's just been, you know, a flip that once made $80,000 today might only make $20,000 or less. That's just the math of it. All right, so for today's housing market, it's not to say that investors are gone. I think they're just more selective. They still exist. They're still out there. Look, there are institutional buyers out there. There's no question about it. I just think that they're being more selective. They're cherry picking the deals now. It's not like 2021 investors were buying aggressively almost everywhere. Now they want a good deal. They want strong rent yields. They're looking for specific opportunities. Now, one good thing is it could reduce competition for other home buyers who are not investors, right? Starter homes. Look, investor activity, if it does cool, does open it up for first-time home buyers and conventional buyers. But, we still have the affordability issue, right? So it doesn't mean that that's going to help out that much. Now, I think one of the most important aspects to this, and I think it's where it hurts the most, fixer-uppers and flippers. I think a lot of flippers now, they just need bigger discounts. They're looking for motivated sellers. And there's just not a lot of that out there. I think even condos, condos in Florida, Texas, Arizona, with all the insurance spikes, HOA increases, right? Reserve requirements. There's a lot of new requirements now for buildings in places like Florida. And I think that they're just becoming more careful with condos unless the numbers are extremely attractive. All right. Now, I'd like to consider this more of a transition market. The market, look, it's transitioning away from, I guess I'd call it that easy money investor frenzy that we saw, back in late 2020, 2021, even into early 2022. This doesn't, I'm not sounding any alarms here based on this. I'm just trying to explain there's just a different mindset and a different behavior that we're seeing from investors of real estate that we hadn't seen before. More selective. All right. Today's investors, what I think they want are lower risk assets. They're looking for stronger long-term fundamentals. Investors today, they're underwriting deals that I think are good for them, and they're being much more conservative about the way they do it. What else could that mean? Well, they have to assume that it's a completely different situation. They have to assume higher vacancies, higher insurance, higher maintenance, slower appreciation. So it's a different mindset than they used to have. Well, this Redfin report, I think it highlights how different today's housing market is compared to the pandemic years. Investors haven't disappeared. They've just become more selective. That's the key. That shift in mindset matters because investors, they're a huge part in this housing market. And if investor demand stays soft while inventory slowly rises, well, that could gradually create a more balanced market going forward. And in some areas, might cause a slowdown or at least a flattening like we've already seen in certain parts of the country. That is it for me today. Thank you so much for listening to today's show. And as always, if you have questions or need specific advice, ideas, or just some help regarding your particular real estate needs or situation, or if you're just looking to buy or sell real estate in Florida, well then DM me on Instagram at The Salib Group, or just send me an email to mark@thesalibgroup.com. Don't forget to leave a rating for the show, follow, subscribe, help others find the show, and be informed and educated about the real estate market just like you. Until next time. Before we end today's show, stop what you're doing and subscribe right now to Real Estate Market Minute Plus. Listen to all episodes ad-free. Get exclusive bonus episodes and content and help support the show's growth, longevity, and future improvements. Go to realestatemarketminute.supercast.com right now. You can also find the link in this episode's show description. Check it out. I know you'll love it.